Alright, welcome back to accounting. Today we're going to do a lesson on depreciation. So, what is depreciation? So depreciation is money paid to purchase property, plants, and equipment. As we talked about before, we do accounting on an accrual basis. So, instead of expensing this all at one time on the income statement, we stretch it out. We expense it over the useful life of the asset. And this is for tangible assets. For intangible assets, we have something similar, and you may have heard of it if you're in the business world, and it's called amortization. So that's for intangible assets like a patent or goodwill, which we will talk about those eventually if you don't know what those are. But just know for property, plant, and equipment, and tangible assets, we do depreciation. And then the intangible version of that is amortization. And we do this because we have accrual basis accounting instead of cash basis accounting. So, I think in order to calculate depreciation, we have three main terms, which the first one is the useful life. So this is the time, the amount of years that we can expect to use the asset, or the amount of time until it's no longer used. And then the acquisition cost. Is essentially just the price we pay up front initially for the property. Initial cost. Still getting used to this tablet here. And then the other one is the residual value. And the residual value is the value of the asset after the useful life is over and it is completely depreciated. It's the value left over after the useful life. Okay. So yeah, once you have these three pieces of information about an asset, essentially what it is so you just need these three pieces of information, and then the acquisition cost is depreciated every year of the useful life until the residual value is reached, or you sell the asset, or you're done with the asset. So yeah, that's the only three things you need to figure out depreciation. So now that you know what depreciation is, we should probably talk about some depreciation methods. So, depreciation methods. So, first thing we have is the production units method. So, production units, this one can be a little confusing. So, production units, this one can be sort of esoteric if you don't understand the operating volume of your machine. So if the machine pushes out an operating volume of 50 units and in that year, and there's a total operating volume of 100 units, well, that's 50% of the operating volume. And the goal of this is to depreciate your asset based on what its output is. So what you do to calculate is you take depreciation is equal to the depreciable cost of the asset, so that's the acquisition cost, so however much you paid for it. Acquisition cost minus residual value. And then you would multiply, let's see if I can scroll this over. And then you will multiply this by the fraction of operating volume in that year. So operating volume in the current year over the total operating volume. So that's how you would depreciate with production units. It's a little complicated, and for many firms, it's sort of esoteric, this piece of information over here in regards to operating volume for a given asset or machine. It can be somewhat tough, so this one isn't as common. And then the next one, I think we wanted to talk about the straight line method. So the straight line method. And this one is really easy. Yeah, it's just a straight line. So let's say we have an asset, and we have its acquisition cost, and then we have its useful life. And basically, the depreciation in a given year is equivalent to 1 over the useful life times the depreciable cost. Acquisition cost minus residual value. I'm like scribbling here. So basically, if you had a useful life of 5 years, you would just subtract 1/5 of the depreciable cost every year. So it would be the same depreciation expense every year. And then the next method I wanted to mention was the declining balance method. And this is similar to the straight line, although it's exponential, or compounds, or decays rather. And basically what you do is you have a depreciation rate, and you multiply it every year by that depreciation rate, and it kind of asymptotes off. So an example would be if you had 1 million yen. I guess my dollar sign is null, given that I'm in yen here. So if you had 1 million yen, and you had a depreciation, that's the depreciable, that's the acquisition cost of your factory or something, and your depreciation rate's 20%. Well, in the second year, you're going to have 800 million yen on your balance sheet in regards to the value of that asset. So that's the declining balance method. You're just multiplying by a growth rate, or rather a rate at which it's depreciated every year. And then you have the sum of the years. Sum of years digits method, I think is what it's called. I may have butchered that a little bit, so maybe Google that or something. Wow, I just tried to underline, and that was not good. Okay, so this one's a little weird. So let's say, just like in the last example, we had 5 years. So let's say we had 5 years for our useful life of an asset. What you would do is in the denominator, so depreciation equals, in the denominator you would sum up, just like as the name hints, you would sum up the digits, just like that, what's that Greek letter? Uppercase sigma or something like that. I don't even really know my Greek letters too well, but the one that looks like this, and you sum stuff, I think that's sigma, right? Uppercase sigma. So you would sum this up, and I believe that to be 15, right? 9, 12, make it 9, 10, 11, 12, 13, 14, 15. Yeah, 15. Doing some mental math, basic counting. Jeez. Guess that's why we're in accounting. Okay. So we would take, that would be the denominator, right? And then whatever period we're in, and we're trying to depreciate or calculate the depreciation expense, it's however many years we have left. So if it's in the first year, we have 5 years left, or in the first period. So you take that fraction and you would multiply it by, again, the depreciable cost. So that's acquisition cost minus residual value. And that's how you get the sum of the years digit method. So for these last two, I think it's important to note that these are accelerated depreciation. So the amount at which the depreciation is expensed, it picks up speed. Let's see if I have any other notes here before I move on. Yeah, I think that covered all the methods I wanted to talk about. So, yeah, like I was saying, these two methods here are accelerated depreciation. They accelerated early. And then let's go back to the other methods we talked about. So straight line, really simple. It's a steady rate. Or not a steady rate, but a steady number. It's a fixed constant every year. It's that 1/5 of the depreciable cost. It's the same expense every year. And then the production unit. This production unit is it's useful because sometimes in the straight line, if you consider the straight line method, you're depreciating by the same expense every year, but the actual usefulness, the actual output, which we talked about here, of that machine, let's say it's a machine or an asset, the output you get from that asset is likely to diminish over time because it gets old and you have to maintenance it or whatever it may be. The amount of output that it's able to output or render, it becomes less efficient over time due to decay and corroding. Well, that's the sort of disadvantage of the straight line system, in that it's the same expense every year, whereas the production units, it actually has that benefit. If you're able to get this sort of esoteric information about operating volume, it's actually based on the amount of operating volume, which is useful in those situations where later down the road you don't want to expense as much depreciation on your income statement when the machine isn't outputting much. So that's kind of the thinking behind these different methods. And then these kind of accelerate early as well when the machine is doing well, or putting out more output. And then I think in my notes, I think that's pretty close to it. I think I wanted to go through like a little example scenario. So typically, change my color here. So we'd have PP, PP&E. I just said PP. That's funny. So we have PP&E. So let's say you buy $10 million, right, as the acquisition costs, and then the depreciation expense, we'll say it's how much do we want to make it? 1/10. Let's say it's a straight line method because that's the easiest to calculate. Another benefit of the straight line, that's super easy to calculate. So let's say it's a straight line, and it's the useful life of this asset is the acquisition cost is $10 million, and the useful life is 10 years, and that means we do. And let's say the residual value is $0. So by the end of the useful life, it'll be worth 0. So 10 minus 0 is 10. 1/10 of 10. That means our depreciation expense will be 10 or $1 million. 1/10 of $10 million is $1 million. So in the first period, we have $10 million as our acquisition cost. And then we have $1 million for every period. Because remember, this is a fixed rate, fixed, steady, constant, whatever you want to say, expense. And this would be typically it's useful in your income or your balance sheet. Sometimes they'll break it out, so they'll put the acquisition cost and be $10 million every year, and then the actual net PP&E. They will subtract this and take the difference, so it'd be 9 Or yeah, I guess they would order this differently. I kind of ordered that badly to where it would be up here, but could be, and then it would be 9,876, and it would drop down, right? Every year would be minus 1 million for our depreciation cost. I kind of ordered that badly, but you get the point, right? But yeah, the purpose they break it out like that is mainly so that, sometimes you can look at a company and based on its PP&E, this number, you can say, oh, that company's big, or oh, that company's small. And if you have an asset that was acquired for $10 million, but somebody's looking at your balance sheet, 9 years down the road, and it only says $1 million, you might say, well, this company's not that big. They don't have that much capital. But in reality, it's good that you have the acquisition cost on your balance sheet, as well as the net asset value, because people can look at this acquisition cost and say, oh, they're actually a pretty big company. And PP&E is actually a really useful line on the balance sheet, mainly because that's what it costs to recreate the company. I mean, all of their factories and properties and equipment and everything except employees and personnel, and of course intellectual property, which is under intangible assets. Everything else that you need for the business to operate is the PP&E. It's the buildings, the office, the software, the equipment, and the forklifts, vehicles, everything is all under PP&E, aside from personnel and intangible intellectual property, things like that. So it's kind of interesting if you look at some companies and look at their PP&E number under the assets section of their balance sheet. You can say, well, this number is way lower than the value of the company, and if you take the value of the company and subtract PP&E, you can say, oh, this is the amount of value that that premium is sort of what their value is aside from their tangible assets. It's kind of cool to sort of compare those two numbers, if that makes sense. So yeah, I think this is much quicker lesson than normal. Basically, we just went over what depreciation is, what amortization is. Then we went over the different types, or the different three main terms. So useful life, acquisition cost, and residual value. And then we went over the methods. So production units, which takes into account operating volume, straight line, which is the fixed rate, declining balance, which is the actual percentage rate that you're it's kind of like exponential decay, or you have early accelerated depreciation, rather. It's a better way to put it, more accurate way. And then you have the sum of the year's digits method, which is kind of funny and goofy in that you sum up the digits of the years as your denominator, and then whatever period you are in, however many years left in useful life, you put that in the numerator, and then that fraction is multiplied by the depreciable cost that we've used in the other methods. And then, of course, we talked about why it's there's some utility in putting the acquisition cost on your balance sheet. It's because people, when they're looking at it, outside users, they can look at it, maybe an investor, and say, oh, this company actually is much larger than what it would be made out to be if they put the net asset value on there isolated. So that's, it's a quick lesson, just kind of an overview of depreciation, everything you need to know. Just, the basic idea of, it's not expensed at the time of the purchase, but rather over the time frame. So instead of all in one period, they stretch it out. So yeah, happy to bless your Friday with this amazing, riveting discussion about depreciation. But yeah, thanks for tuning in. I'll see you in the next video.